All right, let's jump right in. Today, we are taking a deep look at Danaher, a real giant in the life sciences and healthcare world. Now, for years, this company was just a story of steady, consistent growth. But lately, it's hit some serious turbulence. And that leaves us with a really big question. Is this just a temporary slump, a bump in the road, or are we actually watching a fundamental structural shift for the entire industry?
But before we get into the weeds, the usual but very important disclaimer. This is for informational purposes only. It is absolutely not investment advice. My goal here is to really unpack the complex forces at play to give you a clear framework to understand what's actually going on.
So to get to the bottom of this, here's how we're going to break it down. First, we'll look at the numbers that really define the problem. Then we'll get into the post-pandemic effects, the hangover, if you will. We'll explore a new political risk that's cropping up, question the market's forecast for a rebound, and then, finally, we're going to zoom all the way out to look at the long-term bet.
So what is the core issue we're digging into today? Well, it really starts with the market's verdict, and that's reflected in one very, very stark number. A 34% decline in its stock price over the last year. I mean, that is a massive drop. It's lagging the broader market by a huge margin, and it tells you that something is deeply, deeply concerning to investors. So the big question is why? What is driving this?
And look, this isn't just about the stock price dropping. If you look at the company's valuation, it tells an even deeper story. The company's trading at an EV to EBITDA multiple of around 18 times, which is right near its lowest point since 2020. So the market isn't just selling the stock, it's pricing in a period of real sustained difficulty. Let's unpack why.
So how in the world did we get here? Well, to really understand Danaher's present, you have to rewind to the pandemic. That period was just a time of extremes that created this huge distortion in the market, leading to what you can only call a severe post-COVID hangover.
You know, the company's recent past has been this classic boom and bust cycle. 2021 was a dream scenario. Demand for COVID tests, vaccine production equipment, it was just off the charts. But as that pandemic demand vanished, the reversal was just as sudden. Customers were left sitting on these huge stockpiles of inventory, which led to a massive destocking cycle. And to make matters worse, a biotech funding winter set in, and a key growth market for them, China, started to show some major weakness.
So the key thing to get here is that this wasn't just one problem. It was a cascade, one thing hitting after another. The drop in tests and vaccine revenue? Expected. The client destocking? Painful, but that was temporary and is mostly normalized now. But the squeeze in biotech funding and the new competitive pressures in China, those point to some potentially deeper, more structural issues.
But you know, a post-COVID slump was to some degree already baked in. What's new, and frankly, what's potentially more dangerous, is a risk that's now emerging from the political landscape right here in the US. This isn't just about market cycles anymore. We could be talking about a threat to the entire healthcare innovation ecosystem.
And this has created two completely different narratives, a real disconnect. On one side, you have the company saying, hey, these political headlines, it's just noise, it's temporary. But on the other side, you have this growing fear in the market that these proposals are a real structural threat to the very incentives that drive drug discovery in the first place.
So what's at the heart of this fear? It's proposed budget cuts of up to 40% to the National Institutes of Health and other academic research groups. Now, why does that matter so much? Because this public funding, it's the engine of basic science. It's the seed corn that supports all the early-stage research that eventually feeds the pipeline for big pharma and, of course, for companies like Danaher. You disrupt that funding, you could disrupt the creation of new drugs for years to come. But here's the twist. This political uncertainty, it's not a one-way street. Paradoxically, the same environment that's creating this risk might actually be creating a massive opportunity. There is a huge political push to onshore pharmaceutical manufacturing to bring production back to the United States. This policy shift could unlock as much as $300 billion in new domestic investment over the next several years. And if pharma companies are building brand new factories here in the US, guess what they're going to need? They'll need Danaher's equipment, bioreactors, filtration systems, the whole shebang. This could be a really powerful tailwind.
Okay, so we've got a tough present, a complex political landscape, but also a potentially huge onshoring opportunity. So, how is the market forecasting the future? This is where the story gets really, really interesting.
Despite all of these headwinds we've talked about, sell-side analysts are actually projecting a significant reacceleration in revenue growth. They see it jumping from around 3 to 4% all the way up to over 6% in 2026.
This just forces a critical question, right? What is the argument for such a sharp, V-shaped recovery? What are analysts seeing that justifies this kind of jump from a near standstill to pretty robust growth in just a couple of years?
The consensus view seems to be based on this simple idea of normalization, a return to the way things used to be. But the underlying reasons for this rapid turnaround are, to be frank, fragile. The specific things that would suddenly fix the structural issues in life sciences or reverse the competitive dynamics in China, they're just not clear. It feels a lot more like an assumption than a forecast based on hard evidence.
So let's zoom out. If the short to medium term is this cloudy, what is the long-term investment case actually built on? I mean, what are the bedrock trends that the bulls are betting on?
The bull case for Danaher really rests on these powerful, just undeniable secular trends. First, an aging global population needs more healthcare. Simple. Second, there's a fundamental shift in medicine towards biologics, these large, complex molecules that are Danaher's specialty. There are over 20,000 of these in development right now. And finally, the wild card, artificial intelligence.
AI could be the most powerful driver of them all. I mean, think about it. Traditionally, the preclinical phase of discovering a molecule could take 3+ years of painstaking trial-and-error lab work. AI-powered models can now crunch massive databases of proteins and molecules to find the best candidate in just weeks, maybe months. This could dramatically cut costs and, more importantly, exponentially increase the number of new drugs that even enter the pipeline.
And this really brings us to the final multi-billion-dollar question. We have a clear battle playing out. On one side, you have these immense long-term tailwinds from demographics and technology and AI. But on the other side, you have the very real near-term headwinds of a new political reality and a potentially disrupted innovation ecosystem. Which one of these powerful forces is going to win out? That is the question that will define the future for Danaher, and you know what? Probably for the entire industry.